Curt, thank you so much for joining us and having this conversation here today. I've been looking forward to this, especially given the big news that you and your team were named the #1 U.S. special servicer for CMBS, SASB, and CRE CLOs issued in 2025. That's huge. That's awesome. Congratulations.
Yeah, thank you, Andy. Really appreciate that. We're excited about hitting the #1 ranking last year in special servicing new issuance. I really attribute it to my team. It's a testimony how good of a team we have here at Situs. It's a seasoned team. Most of our asset managers have been in the business 30 plus years. So I think our clients acknowledge that experience. They've felt it and seen it over the last 5 years, really, that we've been working on a lot of SASB special servicing assets. And so I think they're comfortable with our crew. You know, we have other people in the shop, in the back office that we've been with 30 plus years as a team as well. So we're pretty much in sync, and we're really happy for the ranking and happy to have this great, what I call a dream team. Happy to have that acknowledged, and I think we're so well positioned for the future with this all-star team that we have in that SASB space. So we're looking for more to come, but really excited that our team put up some results that the folks like. They continue to give us new deals and continue to work closely with them to get more deals in the future.
And that's huge. I'm so proud of you guys, and that whole concept of that experienced team. Like, you guys have seen multiple cycles. You've been through it, right? And so I think that experience is critical, especially as markets feel like there's some question marks lingering. I know there's some interesting data that continues to come out. I think TREP reported 12-year highs in the fourth quarter of 2025 here in terms of some of the special servicing rates that are out there. I'm curious from your perspective, as you and that experienced team kind of looks at the market today, where's it at? What's the market looking like?
Yeah, the market it still has its issues. Everybody has their baseball analogy they use on these things. I like to tell people it's been a while that we've been post COVID. So I tell people I think we're in the second game of a doubleheader, and we're about that third or fourth inning, and the pitching staff's been a little worn, but ours has a lot of energy. I think we can finish off the doubleheader pretty well. But I think seriously, where we come in here though is the maturity defaults are going to continue to be problematic. It's office buildings. It's the haves and have-nots with the office buildings. Some of them are very well positioned. New York, if you're A plus, you're knocking it out of the ballpark. But there's other places where we're not having that sort of rebound. San Francisco's rebounding a little bit. All these maturity defaults are going to keep us busy, I think, for another at least 3 or 4 years. It's just, rent rolls are going to have to be figured out. TILC costs are through the roof these days. So anytime you expect to have a new tenant in place, you're going to have to figure the cost to put that new tenant in place. And that all, goes into the refinancing analysis. So it's going to be difficult, I think, for a lot of people. I think the markets are really interesting. I mentioned New York strong, San Francisco coming back. The rest of the markets, it sort of haves and have-nots. It's property type, office, but within property type, have you put the amenities in? And then within these markets, it's really a function of you can't be too broad with the markets, right? Los Angeles, for instance, downtown LA, struggling big time. Century City doing great. Dallas, uptown doing great. Downtown Dallas not so good. So I think as we dig in, we have to make assumptions that you can't just look at an entire market. You have to dig into the particulars on all these assets, and I think is going to keep us busy, and that's going to keep the state of the market in this haves and have-nots state for quite some time. That's going to keep us busy with the maturities.
Yeah, I imagine that then forces you all to really understand kind of all those nuances and dynamics going on. Again, not at the market level, not at the national level, not at the market level, but at the sub-market level, to really understand, hey, how is this slight nuance doing compared to this spot? You mentioned office, right? And that kind of delineation between, top level office versus kind of maybe those B levels. What about other asset classes? How are we looking industrial, multifamily, some of these other ones that are out there? Any winners, losers, or big themes there?
Yeah, I think hospitality is done fairly well. After bouncing back from COVID, that's something we worked on a lot right when COVID hit.
Mhm.
Large hospitality properties. I think the ones in these CBD areas and these office markets that are struggling are going to continue to struggle as well. They go hand in hand a little bit. So I
Mhm.
think hospitality and that CBD space will be continue to have issues. I think leisure hospitality's done well. Certainly, if we have an economic downturn, that gets hit. So we have to keep our
Mhm.
eyes on that. I think in the multifamily space, the Sun Belt has a little oversupply, a little struggle there. I think rents nationwide are struggling right now to go
Mhm.
up. And we all know costs always continue to go up, and certainly
Right.
property taxes are hitting a lot of states now. So I foresee some stumbles for multifamily. I don't think it's going to be near as troubled asset class as it was during the great financial
Mhm.
crisis when we had really thousands of multifamily properties we worked
Right.
on in our special servicing shop. I think the economy is stronger than that point in time. Employment's relatively strong. So I see speed bumps there, but I don't see a real downturn there.
Got it. Makes sense. So it's interesting. It's an interesting time in the market with a confluence of a lot of different things going on. Again, market differentiation, it sounds like, submarket versus submarket, asset differentiation, even types of assets within those categories. Let's talk loans, right? SASB. This is an area, that I'm curious about. You guys are crushing it, obviously, right? Number one SASB US special servicer by volume in 2025. And these SASB loans are wild now. I was talking to someone on your team a couple of days ago, and they were kind of reminiscing back in the day, right? Maybe a $50 million loan felt big. Now we've got these SASBs at a billion, billion and a half. How do you even approach this from a deal workout standpoint?
Yeah, they're difficult. They're tricky.
Yeah.
I'm really fortunate to have such a seasoned team.
Yeah.
Our asset managers, most of these guys have been in the business for 30 years, so they're so well suited for these difficult SASB assets, and they're tough. They're institutional borrowers.
Mhm.
A lot of loans that are split up into various pools and tranches, and a lot of moving pieces on this. I sometimes tell people it feels like three-dimensional chess more so than it did back in the day when we were smaller assets and just
Right.
dealing with the borrower most of the time. So a lot of moving pieces on them. We're well suited. We certainly in the last 5 or 6 years have a lot of experience now in that SASB space. So
Mhm.
many have come through the door that we've successfully worked out. So they're difficult. They take a lot of time. They take a team effort, really. And
Yeah.
so it's not just an individual asset manager looking at an individual SASB. We work on these as an experienced team. And that's, I think, what has generated the most results for us and really separates us from our competitors, having this level of experience in that SASB
Yeah.
space.
Yeah, I imagine at that level, again, you're dealing with highly sophisticated borrowers. Everyone involved in the process is sophisticated.
Mhm.
So really being able to dive in, dive deep, leverage that experience is going to be critical. CRE CLOs, it's an interesting one for me as well, right? I feel like we go through kind of these ebbs and flows in terms of the popularity of the CLO.
Mhm.
At CREFC earlier this year, felt like CRE CLOs are making a comeback. How are you guys looking at these from a special perspective? Obviously, number one in the space in 2025, so you're seeing them. But how do you even how are you approaching it? How are you thinking about
Yeah, I mean, CRE CLOs, a lot of these are repositioning loans. They have a business plan. I think it's an interesting product type, and it's done really well. And we've done really well in that space working out some of those loans. We work closely with the collateral manager, and in most cases, this collateral manager, unlike maybe a CMBS deal, really knows the asset inside and
them?
out and was part of that business plan or understanding that business plan. So we work closely with the collateral manager to determine the best outcomes
Mhm.
resolution strategies, and I think a lot of them have worked out well. It's been an interesting time. You have a repositioning plan. Economy goes a little sideways with COVID. Most of these have done quite well, and
Mhm.
I attribute that to the experience of the collateral managers that put these deals together in the first place. And I think our ability to work closely with them as our clients
Mhm.
and come up with these solutions really has separated us, putting experienced people again on these deals with our collateral managers. And we've gotten huge results, and I expect we'll continue to do so.
No, it's big. Yeah, I know that our primary servicing, and asset management team is seeing these coming through the doors a lot more now. So I imagine that connectivity with them being able to understand kind of all the nuance, all the details that are in and happening within those assets, and then to be able to link that if that goes to special and whatever might happen from there is pretty critical. And I imagine a step up compared to those that are operating as a special servicer outside of the environment with an established and strong asset manager.
Yeah, certainly. Yeah, our primary teams are typically doing quite a bit of surveillance while it's a performing loan before it gets to us. So there's a lot of information there we can tap into when it does head on over to us. So it's been a nice product type for us to work on primary and special, and I see us being more involved in that asset type as we move forward.
Well, you guys have been busy. 2025 obviously huge, a lot of stuff going on here early 2026, but do you think about 2026, Curt? What's the theme that you're kind of anticipating for the remainder of this year?
Yeah, I think in 2026, it's the haves and the have-nots a little bit. Some markets are going to do well, some markets not so well, some property types well, some markets not so well. But I do think it's the maturity defaults really is the theme. Yeah. We're just going to need to keep our head down, working on these maturity defaults, figuring out the best resolutions. It's difficult. You're at a time when sometimes in some of these markets, it's hard to see where it's going to turn around, and to make those hard decisions sometimes, like, hey, an old special servicing term is your first loss is your best loss. Well, that's the case in some of these now. So I see in 26 that we're going to probably be going down the liquidation path a little bit more than what we did in the past. So some of these where we're not seeing real traction, and with some other things going on within the industry, again, TILC costs through the roof. If for whatever reason we can't advance for a TILC, we're sort of dead in the water. So that needs to be a part of our analysis as we look at these going forward. But yeah, 2026 will be an interesting year. I think there's going to be a lot of great successes, but I think there's going to be some deals where I think you'll see special servicers start to liquidate a little bit more, probably take some haircuts now to avoid bigger losses down the road.
That's big, I think, coming from you and your team, right? Because you guys have been so resolution focused for so long. What is it, 93% resolution rate over the last 5 years or so? So this feels like a little bit of a shift that special servicers, everyone's hands going to be a little more forced, it seems like maybe.
Yeah, I think so. I think some hands will be a little bit forced. It's just time in some of these markets that where we just don't see it happening for a long, long time. There's certain markets, San Francisco, okay, we could kind of see that coming back, and now it's really coming back. So we're kind of happy we didn't liquidate anything in San Francisco. Other markets, we're just not seeing the traction, and that combined with the master servicing advancing issue, and we understand our master servicers can only go so high on their advances, but it's just the reality that we have to look at a market and say it's time that we need to go down the liquidation road in some of these. Again, another part of that, I think one of the reasons we haven't gone down the liquidation road as much is we have really strong, and especially in the SASB space, sponsors that for the most part know what they're doing for the most part. So you can work with these players a lot, but eventually you get to some of these markets where even the sponsor says, hey, it's not happening here. So you don't have a sponsor to work with, you have it in REO or receivership. And those are the deals where I think it's time to, fish or cut bait, basically.
Yeah, makes sense. Makes total sense. Well, I know I'm biased, but I'll say in the midst of what could be a maturity wall, kind of keeping, a lot of potential stress out in the marketplace, I know having the experience and the backing of you and your team, those all-stars, right? To me, it's going to be a difference maker. But Curt, I appreciate it. Again, congratulations. Huge year for you and the team. Proud of you all and excited for all that you will do here in 2026 and beyond. And, let's do this again. Let's chat again soon.
All right. Sounds good, Andy. Appreciate it.